Hello traders, Gary Wagner here, just about 11 o'clock in Honolulu. It is Thursday, February 11th, 2016, and we are looking at a Dow Jones Industrial Average, although well off of the lows today, under tremendous pressure as we have seen a literal meltdown in the U.S. equities markets, continuation of a meltdown in oil, some real concern about European banks and the banks as a whole in terms of stability and a potential recession. Now, the key right now on a technical basis is that although we saw this market trade lower today, it had a low of 15,503. We're at 15,691. So we're almost 200 points off of the low. And I draw your attention to this first chart that we will pull up today. And this is a chart which, of course, is a 240-minute chart. So very, very, very short-term chart itself, but it still has some good data points. And what we're looking at when we look at this chart is the fact that when we consider these lows that came in right here at around 15,600, and you'll really see the importance of the area that we're at when we start to look at the S&Ps. You can see that, first of all, we had this tremendous sell-off. Each bar represents about 4 hours in trading, but we did have our recovery. This is where it came back up from that 200-point lower print that we had earlier in the day. It did not, however, exceed nor close near the highs that we saw back in the middle of January when the market actually breached and reached a low that was at around 15,450, roughly in this area. And that would be, if I extended this line, you would see it in that way. And so traders, we take that information and of course carry it over into the S&P 500. We're looking, of course, at the E-mini, trading off about 21 points or 1.16% lower on the day. Compare that to the drawdown in the Dow, which is roughly at that same point. You can see in terms of percentages that with the same kind of drawdown as well as the same kind of move back up. Now, 18,023, low 18,002, that's significant. We'll look at that on our chart. High 18,047. And here's where you can really see the tell of the tape, so to speak. And this, to me, is what is, if anything, the most scary point of what we're looking at. And that is as follows. When we consider this market moving up throughout last year, then when we consider the fact that we almost matched these highs towards the end of last year, but then went into this dramatic correction, and then realized that the only real way to compare the sell-off that we saw was to compare it by looking at what happened back in August of last year, which is what I've termed the August meltdown due to concerns in China, in which we saw this market run from about 2120 down to these lows at about 1830. I'm going to draw a line across here. Now, up until this point, meaning today, this is a weekly chart, of course, but this includes today's activity. We never had the Standard & Poor's on a closing basis. We certainly got it on an intraday basis, but on a closing basis, we never saw the S&P close below the lows that were achieved during the August meltdown. And that was really up until today. Today's move really takes us into question because of the fact that we sincerely have a close at this point that is below that point. Now, as you know, all throughout the week, we have been trying to ascertain whether or not what we're looking at is basically, and when I say simple correction, nothing simple when the market trades off like this, but whether it was a correction, meaning you've got a strong rally, you're going to give back a percentage of that and return to a strong rally. That's what a correction is, as opposed to a bear market in which you have a strong rally and now you get a strong sell-off. It's a whole different animal, of course, because now we're looking for lower pricing rather than looking for a place to find a bounce and see the market move back up. We've been attempting to determine which of these two scenarios the current market system currently falls in. Now, all throughout the beginning of this year, and the beginning of this year happened quite recently, but all throughout the beginning of this year, my sense was even when we saw this major fall here, because it was in the confines and remained above 1900, which is our 75% retracement from the top here to the bottom here, I felt that we still had an opportunity, although it was really in question because we'd gone past the 61% retracement, but we could in fact see this market move back up. We didn't take any positions. We've been sidelined for the better part of this year. The only real markets that I'm currently looking at in terms of real strong plays are going to be crude oil. However, with this new price move into this area, if we do move into a bear market, obviously there's a lot of money to be made on the short side by shorting this Standard & Poor's 500. But most importantly, the biggest thing to take out of today, of course, my trending market subscribers are also gold forecast subscribers. So we are making a very, very healthy profit right now in our long gold trade. And so I want to add to that, but add to that cautiously. And this was what I was wondering whether or not it would happen in this particular action, meaning a close below 1832, which is matching these lows here, is really the question that I needed answered, whether or not the market would hold here or break through. At least for the time being, there's no doubt that there is a high probability that we will see an extended sell-off in this market. If we go any lower, we're already just flirting with a bear market as opposed to a bull market in correction. Lastly, let's take a look at crude. And crude, of course, is now well off of the lows of the day. It's only off about 0.5%. Now, 0.5% in any other market would be a considerable move, not in oil. Oil, if it's moving 3, 4, 5% today, it's almost normal. But look at these lows, 26.05, found some support right at 26. I still believe that this market is going to come in and test these lows that it recently hit, which it tested today. But I believe that unless we see it bounce from this area, we're probably going to see it head closer to 20. That's what I'm actually looking for if it breaks $25 per barrel. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for the weekly wrap-up and review. Bye-bye.